Welcome back to Gold Rush Reporter, everyone. If you think the stock market's AI boom is the biggest story right now, think again. Gold and silver are quietly rewriting history while the public is glued to their screens, chasing tech stocks and hype. Let me show you what's really happening. We're living through a historic moment in the precious metals market. Gold has surged almost 40% in the last 5 months, quietly outperforming the S&P 500, which is up just 9% over the same period. Since 2023, gold has doubled. That's right. 100% gains, while the headlines are all about tech, AI, and stock rallies. And yet, most people don't even notice. Silver, the underestimated monetary metal, is just waking up. The technical setup is screaming for attention. We're talking industrial demand hitting record levels for solar panels, EBS systems, and 5G infrastructure. Combine that with a market structurally in deficit, dwindling inventories at COMEX and LBMA vaults, and physical demand surging. What we're seeing isn't a run. It's a tidal wave waiting to happen. And it's not just the public and retail investors getting involved. Insiders, the big money, the most connected players are quietly exiting equities. They're walking away from stocks, margin, and options exposure at a rate of 7-1. And guess where that capital is flowing? Into gold and silver, physical metal, not digital promises, real ounces. Meanwhile, mainstream media is silent. CNBC, Fox Business, even Jim Cramer are all focused on what? Tech hype, consumer distractions, and headlines that make you feel busy but tell you nothing. Meanwhile, the wealthiest investors are quietly stacking gold and silver, knowing full well that paper wealth is only as good as the trust backing it, and that trust is eroding fast. We're also seeing global signals that can't be ignored. Just this month, Poland's central bank announced it's increasing gold holdings to 30% of reserves. That's not a hedge, that's a statement. Adam Glapiński, the central bank governor, put it plainly. Fortune favors the prepared. In a world where digital systems can fail, gold doesn't blink. So if you're wondering why gold and silver are outperforming, while the public is all in on stocks, margin, and options, this is why. Insiders are moving, central banks are stacking, and the structural fundamentals are shifting beneath the surface. And silver, still in the shadow of gold's rally, is set up for a breakout that could dwarf even what we've seen with gold so far. Stay tuned, because in this series we'll dive deep into the mechanics, history, and future potential of gold and silver markets, how insiders are moving, how shortages and industrial demand are impacting prices, and what you need to know to understand this historic cycle. Now that we've set the stage, let's dig into why silver is the real sleeping giant here, and why gold is screaming louder than most people realize. The technical setup is clear. Silver is in a massive cup and handle formation, a classic continuation pattern. The cup has been decades in the making, stretching back to the 1980s, and the handle represents tightening ranges like 2011. Once silver breaks above the rim, the highs we saw in 1980 and 2011, the price can go parabolic. And when you factor in physical shortages, the demand from institutional money, and the stacking by BRICS countries, triple-digit silver isn't just possible, it's inevitable. Meanwhile, gold has quietly been outperforming everything else. Over the last 6 months, gold is up 37%, while the S&P 500, even with its AI-driven rally, is up just 9%. That means gold has outperformed the biggest tech boom since the internet, 4 times over. Yet, mainstream media is silent. CNBC, crickets, Fox Business, nada. Jim Cramer, still hyping stocks while gold quietly crushes the index he worships. here's where the big picture gets dangerous and fascinating. US debt just crossed $36 trillion, with over $1 trillion in annual interest payments, larger than the entire defense budget. A third of that debt must be refinanced in the next 2 years. The Fed is trapped. Raise rates too high and you collapse the banking system, treasuries, and housing. Cut rates too soon and the dollar implodes. Either way, debasement is baked in, and gold is screaming higher because of it. Silver, on the other hand, is facing a technical and physical squeeze. COMEX deliveries are massive, and London lease rates are spiking, currently at 5 to 6.5% compared to the normal 1%. That means borrowing silver to short it is now extremely costly. The available free float in London is tiny, around 140 million ounces, against 1 to 2 billion ounces in paper claims. This mismatch is setting the stage for extreme pressure on short positions. The market can't handle this much demand with so little physical supply, and that's why silver's breakout isn't just technical, it's fundamental. And it's global. Poland's central bank just raised gold holdings to 30% of reserves, signaling state-level preparation for systemic risk. BRICS nations, China, Russia, India, Turkey, Kazakhstan, are stacking gold, bypassing treasuries, and preparing for a world where the dollar isn't untouchable. The message is clear. Trust in paper and digital money is eroding, and gold is the ultimate hedge. Industrial demand for silver is exploding, supply is stagnant, and investment demand is heating up. This is a structural deficit for the third year in a row. That's not a minor blip, it's the perfect setup for a supply squeeze that can send prices far higher. So far, the public is still chasing stocks and hype, oblivious to the quiet accumulation by insiders and central banks. But the writing is on the wall. Gold has already proven its strength. Silver is following, and when it breaks out fully, retail investors may be left chasing a runaway train. Let's step back into history for some context because silver isn't moving in a vacuum. The last time we saw a silver bull run of this magnitude was the late 1970s, culminating in January 1980. Back then, the Hunt brothers had massive concentrated positions, and the Fed, along with the commodities exchanges, moved aggressively to cap the price. They raised margin requirements, imposed position limits, and eventually implemented liquidation orders only for silver futures. That rule meant silver prices could only go down until the restriction was lifted. Even with all these interventions, silver exploded from roughly $6 at the beginning of 1979 to $50 by early 1980, almost a tenfold increase in a single year. Gold was surging too, and the dollar nearly collapsed. The key takeaway? When demand, scarcity, and technical setups align, nothing, not even government manipulation, can stop the price from moving sharply. And that scenario is eerily reminiscent of today. Fast forward to 2025, and we're seeing a similar confluence. Insiders and central banks are hoarding gold. The US dollar faces structural risk, and silver is structurally tight. Physical delivery on COMEX is spiking, lease rates in London are extreme, and open interest is dropping as speculators scramble to cover positions. Meanwhile, retail investors are oblivious, still chasing stocks and hype like the Hunt's retail peers back then. Here's another layer. The tech boom and AI revolution have created one of the strongest equity rallies in history. The S&P 500 is up 1,650 points in just 5 months. Yet gold has quietly outperformed, up 37% in that same window. This is happening while public investors are levered to the teeth. Over $1 trillion in margin debt, record options exposure, and historically high stock allocations. Meanwhile, the largest money in the world is quietly exiting equities at a 7-to-1 clip, moving into tangible assets like gold and silver. And it's not just the US. The BRICS bloc is building a parallel financial system. China, Russia, India, Turkey, and Kazakhstan are stacking gold at record pace. This isn't speculation, this is geopolitical positioning. They understand that dollars can be frozen, but gold cannot. If the world moves to gold-backed settlements, the smaller and more liquid silver market will follow. It will ride shotgun to gold, but with more explosive potential due to its thinner market. The industrial side can't be ignored either. Solar panels, 5G infrastructure, electric vehicles all require silver, and mine supply is stagnating. 3 consecutive years of deficits in silver production against industrial demand mean that any surge in investment demand could ignite a frenzy. Think back to 1980. Concentrated positions, leverage, physical shortages, and a technical breakout. We are seeing the modern equivalent today. So, the setup is clear. A structurally tight market, explosive industrial and investment demand, central banks hoarding gold, insiders exiting equities, and a retail crowd still distracted by tech headlines. It's textbook. Everything aligns for precious metals, and the breakout is already underway. Now, let's zoom in on what's happening in 2025, because the technicals and fundamentals are painting a picture that is hard to ignore. On COMEX, deliveries of silver have surged. 58 million ounces since late August alone. That's nearly 11,000 tons year to date, an extraordinary number. Physical liquidity is tightening fast. Lease rates in London are spiking, hovering between 5% and 6.5%, way above normal. When lease rates are this high, short sellers are basically being taxed for every ounce they try to borrow, and those holding physical silver aren't budging. Open interest is falling even as demand rises, a sign that speculators are being squeezed. Think about it. If you're short and cannot find silver to cover, or the cost to borrow it is outrageous, the pressure mounts. This is classic short squeeze territory, just like we saw with stocks, but on a global scale, in a commodity that is already structurally tight. LBMA data tells the same story. There are between 1 to 2 billion ounces in paper claims versus only about 140 million ounces available for free delivery. That's an absurd mismatch. If even a fraction of those claims are called in for delivery, the system would be strained beyond belief. Meanwhile, gold continues to quietly outperform. Insiders are leaving the equity market at record rates and reallocating to tangible assets. Central banks are stacking physical gold as insurance. Poland recently announced plans to increase its gold reserves from 22% to 30% of total holdings. This is a signal, not speculation. Governments are preparing for scenarios where digital and paper assets could fail, and gold is the ultimate hedge. Now combine this with the geopolitical backdrop. BRICS nations, China, Russia, India, Turkey, and Kazakhstan are building a parallel system outside the dollar. They are buying gold aggressively while shunning US treasuries. This isn't just strategic, it's defensive. They know that if the US dollar falters or becomes weaponized through sanctions or digital manipulation, their reserves need to remain liquid, secure, and universally accepted. Silver, with its smaller market size, is poised to follow gold, but with much greater price volatility. Technically, silver is breaking out of multi-year consolidation. Price action has decisively moved above key resistance levels, and the momentum indicators are screaming overbought. But in this market, overbought can persist for months if fundamentals support it. Gold's breakout above its own consolidation range is confirming that institutional demand is real, not speculative. Add industrial demand on top of this. Solar panels, EVs, 5G, electronics, all consuming record amounts of silver. Combined with stagnant mine supply, shrinking inventories, and mounting physical demand, the setup for a squeeze is perfect. History proves that when all these conditions converge, technical breakout, fundamental shortage, institutional accumulation, and geopolitical pressure, the resulting price moves are violent. In short, the system is tightening at multiple levels simultaneously. COMEX is flush with metal, LBMA is strained, insiders are exiting stocks, bricks are stacking gold, and industrial demand is parabolic. Silver is no longer a sleeping giant. It's waking up with a vengeance. Anyone watching carefully can see the signals. They're just being drowned out by mainstream media headlines and retail distractions. As we step back and connect the dots, the picture becomes impossible to ignore. We have insiders exiting stocks at a 7-to-1 ratio, record leverage in equities, and a mainstream public oblivious to the warning signs. Meanwhile, central banks and BRICS nations are quietly stacking gold, and COMEX silver deliveries are hitting unprecedented numbers. Industrial demand for silver is skyrocketing. Inventories are shrinking, and lease rates are punishing short sellers. Every piece of evidence points toward one inevitable conclusion. The next leg of the precious metals bull market is underway. History gives us a roadmap. Remember 1980? Silver hit $50 an ounce when gold was $850, a roughly 17-to-1 ratio. Today, with gold at $3,700 and silver mid-40s, even a partial replay of that ratio implies silver breaking triple digits. The math isn't speculative. It's historical precedent combined with current fundamentals. Back then, the Hunt brothers faced margin hikes, position limits, and liquidation rules. Prices surged regardless. Today, the supply-demand mismatch is far more pronounced, and global demand is even more insatiable. Technically, silver has broken out of a multi-year cup and handle pattern. Momentum is strong, resistance levels have been cleared, and the market is structurally tight. Gold, already outperforming equities during the biggest tech boom since the internet, confirms that institutional money is flowing into metals, not stocks. Retail may still be distracted by AI hype and social media, but history shows that the early movers capture the gains. The geopolitical context cannot be overstated. BRICS nations are building a parallel financial system. Russia, China, India, Turkey, and Kazakhstan are accumulating gold to hedge against the weaponization of the dollar. Central banks understand that physical metal is the ultimate insurance in a world dominated by digital records, shadow banking, and geopolitical risk. Silver, smaller and more volatile, is perfectly positioned to follow suit. The takeaway is clear. Triple-digit silver is not a fringe prediction. It is a plausible outcome based on supply, demand, geopolitical shifts, and historical precedent. Gold's ongoing outperformance and record central bank accumulation reinforce this trajectory. Insiders know it, industrial users know it, and the system itself is signaling it. If you want to stay ahead of this cycle, now is the time to pay attention. Not just to the headlines, but to the market signals that matter. Follow the deliveries, watch the lease rates, monitor central bank activity, and understand that precious metals are not just investments, they are protection, insurance, and a store of real value in a collapsing fiat system. Stay informed with Gold Rush Reporter. Subscribe to receive real-time updates on gold and silver prices, delivery alerts, and exclusive analysis unavailable to the general public. The financial world may be distracted, but those who understand history and fundamentals will be ready when the metals market makes its next explosive move.